Eagles. Let's have a great week. Let's pick our spots. Let's let the markets come to us and let's exploit it. Okay, I'm the exploiter this week. Everyone doing okay? Hi, Patrick, how are you? I see a contemporary in the room, Scott Pickering. Welcome to Face, Scott. Looks like Face is a place where professionals come to spend a little time and do some intelligence gathering. Good call, Scott. Okay, so the culprit for what's happened in equities that everyone's pointing to has been yields going up, yields going up. Well, they've been doing it forever. Now they're, looking for a scapegoat because we were overvalued to do for something like that. I'm looking at yields right here approaching what were objectives, about 3% off a head and shoulders formation from the 265 breakout, something like that. But as you can tell on the 4-hour time frame, after the flight for quality that we had last week, we're not confirming. Okay, not confirming on the 4-hour, not confirming on the 1 hour. This looked like a little double top. Looks like we cleaned out some stops above here. If we close back under the double top, this could be a contrarian trade. I'd go with the shorter side of the curve. I'd be buying notes rather than bonds. And even on the daily, which we had confirmed high after confirmed high, and we're no longer confirming under 70. So beware of being too bearish bonds here. Everyone with me? Because everyone's bearish bonds. I'd be interested to know where they're at on the DSI. Okay, so maybe Steve will cover that in a little bit. So I'm looking for yields to be topping out here and yields to be coming down for at least a correction. And here's the S&Ps. So the question is this just a little bounce? Of course, we held the 200 twice last week. I think this low Friday before the rip, your face-off rally happened was 1 pip underneath this low. But to me, I'll call it a double bottom. You guys know I've taught you guys I look at off numbers. So you count back 2 weeks and where was the close? The close was 27.54. So sometimes these off numbers are magnets. So I know a lot of people are talking about 24.20. Ellioticians are saying 24.20 was the fourth wave of lesser degree. Not all my thoughts are original. I check out what the work of people I respect as well. Kind of gives me, a little bit more information when I look at the screen myself. So it wouldn't surprise me to see one more rally to 27.50. Okay, although I don't know how to get on board unless it does this. But I don't think this is a low. Blake doesn't think it's the low. If you watch his week ahead video. Okay, so the dollar, it would be helpful if the dollar would come off. That would take also some of the pressure off. So if you think about yields, maybe, the dollar did nothing with yields going up. It makes me think if there's a bear market rally in bonds and yields come down, would that make the dollar more vulnerable? So something we'll see. And then something else that's going on, we had 58.80 as important level in crude. Okay, and we're getting a pretty nice bounce off the washout low from Friday as well. Why can't we rally back to 62.5, something like that? This was a big break, right? So I'd look for fib retracements. I'm not sure this is it, okay, because we did confirm the low. But if you notice, there was an event in the Middle East where Iranians in Syria shot down an Israeli jet. The Israelis really don't care for that. So, you know, a la Kirk Spano, who I've had in here a few times, a lot of things are pointing towards things heating up. I think that's going to be behind the next crude rally, although I think we could rally and then break one more time, maybe even back down to 55. So to me, this is an oversold bounce. I don't know if it's going to be, I know it's a bottom. It's not the bottom in my view. And then just a little something macro. And I know everyone's saying, you know, it's untradeable, euro pound's untradeable, but I keep looking at the weekly chart here and, you know, it looks okay to me, even on a shorter term basis on the 4 hour. This was pretty wild action, but they keep trying to take it down. You have nothing but bears that were looking for a breakdown under 87, and we're closer to maybe a breakout over 89. Which would take it to 91, okay? And my big picture is on the weekly, that's a daily, that we end up with some type of 3 drive formation up around in the upper 93s here. And I think that's when the dollar is gonna bottom. I'm gonna use this, if I don't trade it or not. Up here, I think this is where the dollar will bottom. I think it will be new lows in the dollar if this happens, because I don't think that we could get to 94 just with pound weakness anymore. You know, we held because of pound weakness. Euro still hasn't done anything. I still think there's one more high coming in euro, and this 94 level is going to be important. When you look at it on the monthly, it still will be a lower high. See this high? Also look at the year, okay? 2008, during a financial crisis, we had this kind of action, okay? So thinking we could rally back up here one more time, that'd be about the 88% fib level, and then perhaps with a big dollar rally phase, get something like that from here. I know that's very macro long term, but no one wants to trade this, and you have a positive month, you have a positive week, and to me, it's kind of like looking at the Mona Lisa and part of her face is missing. So looking for in face, one more drive into the upper 93, 94 level, which is, you know, 500 pips or so from here. So kind of contrary, people are saying it's untradeable. It's very whippy, very choppy. It's probably the type of trade you just have to not watch and protect yourself with stops under 87, because if it gets through there again, then the bears are right. But I'm thinking this is going to happen in the next several weeks or a few months up here. So those are my views. A little, some short-term stuff. Watch the off number in S&Ps. Watch EG. You could probably ride oil for a little while, and S&Ps. My bet is that we're going to get some type of recovery before we take out the double bottom up to the off number, which is 2750, which is also the 200 on the 4 hour time frame. Everyone with me? Hi, Kareem. I hope everyone had time to get set up over the weekend, because it's going to be a wild week and you're going to need more than an hour of analysis. You got to be part of this. You guys are on the Jumbotron. Okay, so, you know, here we have a community of subscribers that are sharing everything. Remember I was asking about DSI? Well, okay, here we got it. T-bonds 13%. So up a little bit, but still very, you know, counter trend. And in order to be part of this, guys, you have to be part of this. And if you don't want to make a huge commitment, can at least take a trial. I don't know what that is. But here's right here. And we have the link up in the room. Okay. So with that being said, I'm going to turn it over to Blake and see where his head's at this morning with the dollar. You know, pretty muted action all last week with the volatility we had in equities, Blake. And I know you have a nice article. You have a nice article published on Business Insider that attempts to explain or what you see happening there.
Yeah, the FX market, and good morning, Dale. I hope you had a great weekend. You asked me where my head's at. My head's actually rather stuffy. So
okay, allergy season.
It is allergy season. It actually woke me up at like midnight last night, and as a result, I'm stuffed up all over the place. But you know, that's kind of like that's kind of the theme of the FX market right now. The FX market's actually really slow and very
congestion.
It is. It really is. And frankly, people, you know, everybody that I talk to, no one knows what to do with the dollar. Other than, you know, we know kind of what levels to look out for, but it's the FX market's almost directionless, despite all this volatility that we're seeing in the equity markets. And I don't know if it's because you know, attention has been elsewhere because of the equity markets, or we're really waiting on Wednesday when we see the inflation data out of the U.S. to see how you know, see if CPI is really you know, going to pick up here in the U.S. And I think that's kind of what everybody's waiting for. But that doesn't mean that we don't have some pretty important levels to watch. First and foremost, this is the euro dollar, and you can see the euro dollar, in my opinion, and let me grab a pen here. You can see the euro dollar's box between a 123 and 122 level. So this is kind of the playground, if you will, for the euro. So, you know, the thing is you know, not to be too directional while we're below 123 and above 122. All right, so that's the good news. Bad news is, excuse me, we don't know what direction it's going to break. My 2 cents is if you look at the dollar still looks like it's recovering. I think the dollar will eventually break higher, meaning the euro is going to eventually break lower, I think. And that, but it probably won't happen ahead of Wednesday, knowing that the inflation data is on Wednesday. And so with that being said, if you want to play the dollar long, I don't know if this is necessarily the place to do it. Right at this moment in time, maybe a rally back to 123, maybe, you know, right up here around 123, 123.10. That's the place to be on the short side of the euro, and that's the way I'm going to play it. I'd rather play the ranges. And if you're like, well, I don't want to be long the dollar, I actually want to be short the dollar. Well, this probably isn't the place to do it either. You probably want to be long closer to 122. So, and I don't know if I'm going to be right and there's going to be eventual dollar strength, or the trend is going to continue lower for the dollar and the euro dollar is going to head higher, and we end up breaking through 123. But I think positioning yourself in the euro long or short can be at better places. You know, I don't look at the market and, you know, and suggest that I'm right, because I'm wrong a lot. So it doesn't, you know, to me it's not whether I'm right or wrong. It's, you know, where can I enter the best point to reduce my risk in case I'm wrong, and that's not here. If you look at this again, I'm just kind of drawing out the range. I think you have to play it either, you know, to the long side on the euro down here at 122, or on the short side up here at 123, but not where we're currently at. And that's how I'm looking at the euro dollar right at this moment in time. The pound, you know, the pound's actually trading pretty heavy here. You know, I'm actually quite surprised at how heavy the cable is trading, which, you know, if you're looking to be long the dollar, the pound might actually be the trade to be, you know, the pair to trade, being short the pound, which I'm not. I don't have any positions in dollars at the moment, but this might be, the way or the trade to look at, or the pair to look at, because the pound dollar, the cable is trading relatively heavy. I think that a break back below 138 is going to be, you're going to get some cable longs that are like, rather deflated if we break through the 138 level. The Aussie's trading fairly heavy. I've been thinking that we're coming down to the 618 retracement, and we stopped short of that. So let me get rid of these lines. Those were drawn from last week. I thought we were coming down here to the 618, and we came pretty close. I mean, we came to 77.50, and then, but look, the bounces are very, very minimal in the Aussie dollar. It's not, there's not a whole lot of life right there. And I'll tell you, longs are probably a little disturbed, because not only did we pop out of this channel, this up channel, we fell out of it, but more importantly is we broke back below. Let's go over a weekly chart. We broke back below this longer term broken trend line. So I'm sure longs right now are kind of like, oh, that sucks. I was really expecting it to bounce at 79 cents and continue higher, but the Aussie is weak, and it makes sense, because stocks are very volatile. We've seen them come off their highs pretty aggressively. So to see the Aussie dollar underperforming doesn't surprise me at all. And neither does the Kiwi dollar. The Kiwi dollar is a very similar type of situation. Actually, the Kiwi has held up better than the Aussie, and we're still above the 200-day moving average. I think we can get a little bit lower towards 71.50 before showing any type of bounce.
Any view on gold, Blake? It held where it had to. 1310 was kind of an important level, and quietly it held it. But that's kind of an ugly day, isn't it? Yeah.
Yeah. This is gold, and gold is, I guess, what we can look at, and this is your 1310 level right there. We're at this 38% retracement. We've got a possible bull flag pattern. I think the way it goes bid, if it's going to go bid, is because stocks come back under pressure. Now, today that's possible. You might go, well, Blake, the Dow futures right now are up 316 points, 318 points. So gold's probably not going to rally. But how about, and we see this all the time, the Dow's up 300 points right now, but it gets sold right at the open because it fills the gap. So if the stock market comes down right at the open, does that push gold back up towards this 1330 level? And I think
last week 300 points either way meant nothing.
Nothing. Yeah, it's
nothing. It was 5 minutes of action many times.
It was crazy, and that's that volatility is nuts, and that's one of the things that I spoke about during the week ahead video. If you look at, I'll just pull up the Dow really quick, and you think about the magnitude of these moves. We were trading here. This is Friday afternoon, Friday during the day. We were trading at 24,000. Let's just say 24,200. We dropped to 23,300. Okay, this is basically a 700-point drop. 700-point drop, and then a 900-point rally. I mean, Dale, that's some pretty amazing stuff. I mean, to get that type of volatility. And so it shouldn't really surprise us as FX traders that so much attention is on equities right now, because, when you get that type of volatility, that's the playground that everybody, there's obviously a fight going on in that playground. So you don't want to play on your playground. You want to go on the other playground and play over there.
I don't know, man. This playground right here, I don't know. You get whiplash on this playground. I'd be careful. This playground.
For sure. You know, and I'm looking at the Dow, and since I've got it up right now, I mean, you can see how we stopped. This is the downtrend line from you know, last week. So we hit the high, and this is after that head and shoulder pattern. We just knocked our head up against resistance here, and the Dow, it may turn lower. But the flip side is it can also break out. I mean, you know, maybe we break out and we head out. You know, we head up to 25,200. I think, you know, that's entirely possible. And set up for, you know, some sort of Garley pattern. I mean, this is very doable. Okay, right here, very doable. All right. So, you know, can we move higher from here in the stock market? Sure, we absolutely can. But if we stop here, in the equity markets, it wouldn't surprise me, because and you can see exactly why the stock market is stopped. And this is, you know, you take all of Europe. This is, you know, since 5 o'clock, or, you know, for the last 5 hours rather, in European trade, you can see why the Dow futures stopped where they stopped. And like I said, the risk is that if the stock market's up 300 points right now, we could at least, you know, in the early hours of the stock market, we could, you know, give back some of those gains, and maybe, you know, maybe start to rally. So again, and I'm talking about the stock market because that was a long explanation of gold. But going back to your question about gold, gold I think is temporarily supported here, and I think the way it really starts to rally is because, you know, some risk aversion. I think that's the only thing that's really going to get gold up off of its butt and get it moving higher. How
about yields? How about yields coming down, since everyone's so bearish? The bond market. Wow.
There's, you know, really interesting. Here's yields, and I heard you talking a little bit earlier about like yields were, you know, they might come off a little bit here, and bonds might bounce. It's possible, especially with the stock market. If the stock market, you know, continues to weaken, bonds might go bid, which means yields might come down. I think that's entirely possible. I think that the stock market right now very much doesn't like yields where they're at. And I think that if we see a continued rally or we see a sell-off in bonds and a continued rally in yields, that is not going to be good. I was watching this interview with Mulhaney and talking about the budget deficit over the weekend on Fox News, and he was talking about how rates could spike higher, and that's scary. You know, you think about that. You know, if rates continue to spike higher like this, and the stock market is not going to take too kindly to it. So, you know, but I'll tell you, yields look strong, and the bond market still looks weak. Here's the let me go over to the 10-year. Here's the bond market. I mean, it still looks weak, even though we had like what looked like a good reversal candle on Wednesday. You can see that hammer. Actually, I think that was on Thursday. We had this nice reversal candle, still no follow through. Yeah, and you look at the longer term, you know, structure of the bond market. It looks god awful ugly. I mean,
wow.
Big double top here.
Breakdown. Yeah.
Yeah, I mean,
pretty deep.
Oh yeah, I mean the
110, 112 or something like that.
Yeah, the move could take us, yeah, somewhere down here. I mean, realistically, and that's ugly. I mean, you think about that, and you know, where a rate's going to be, you know, and what's that going to do to like the housing market? What's that going to do to deficit?
Yeah, I mean, you know, short-term rates, and we have a lot of our financing, Blake, is short-term paper. You know, a lot of people have said that we should convert from having most of our debt in, you know, short-term paper and go out when rates were low, but they've tripled. Okay, guys, from 0.5 to 1.5. That's a big increase in your interest expense.
Yeah. Good morning, Steve.
Good morning. By the way, Blake, speaking of the deficit, because you mentioned the deficit, I have to tell you that yesterday I was reading, I think it was FT, that the projection for the US deficit with current data is for it to balloon from 2.9% that it is at the moment to 9.7, 9.8% by 2040.
Yeah, that's bullish, right?
Yeah, which with today's data, we're talking about a deficit that would approach like 2 trillion per year.
Yeah, we're
Now,
supposed to exceed $1 trillion this year.
Yeah, yeah. So yeah, exactly. So obviously,
oh my God, we're becoming Greece.
yeah.
Blake, let's rub it in a little bit.
You have some way.
We're going to need the IMF to come bail us out.
You're going to need Yanis Varoufakis to blow you up completely, you mean?
Well, it's actually quite scary if you think about it. And you know, I don't know where the confidence is going to lie in the U.S. economy as deficits balloon like that. It's really, you know, the idea of, well, we're going to spend and then it's going to trickle and it's going to, you know, increase spending, which consumer spending, and therefore we could pay down our deficits faster. I don't know if I really agree with that argument, and so it's scary.
Anyhow, the idea, Blake, of fiscal expansion at the end, or anyhow, definitely closer to the end than the beginning of a business cycle, almost makes no point, right? I mean, you're supposed to be doing that during a recession. It's called like counter-cyclical, economic policies, because during a recession you want to stimulate the economy as fast as possible to start creating jobs, for the unemployment to start falling after a period that it has increased, etc., etc. I mean, going through that kind of economic policies at the end or near the end of an expansion cycle, when unemployment is already almost at 4%, at record lows,
and
now
we're talking infrastructure, Steve. I heard an interview that by a very good economist who talked about volatility coming back. I think he was with Fareed Zakaria on CNN, and he said, you know, governments are supposed to be running budget surpluses
during expansion.
Right.
Yeah.
So if we're running a deficit during an expansion, what are we going to do if we go into recession? We can't.
I'm going to tell you what, you're going to triple the deficit. I mean, honestly,
Right.
if we go into a recession within 1 to 2 years from now, which in my opinion is a very, very high probability, even mathematically speaking, that will have already made this expansion cycle the biggest we have on record. And, you know, even if you believe to basic mean reversion, it should happen, right? I mean, this is how the economy works. That means that if you're already running a 1 trillion deficit, you will at least for a few years be running a 2 trillion deficit, and that will pile up the debt in zero time, and that's going to make things even worse, and the possibility of a recovery even slower, and you know, the jitters.
We could have a sovereign debt crisis under those conditions and a currency crisis at the same time, right?
Absolutely, absolutely. And you know something, it's something that's bound to happen in the way that governments work. And you know, you can see this is one of the effects, unfortunately, that you see due to political cycle. For example, do you have any doubt that Trump has advisors? Okay, his advisors have definitely told him that, listen, we are already in a very mature expansion, and you know, it's very likely that we're going to go in a recession during your presidency. So in my opinion, and I would say that for any politician, it doesn't have to do specifically with Trump, and that's one of the problems that has exacerbated the economic and financial problems that we have all over the world, is that it's obvious that Trump is going to be doing what he's going to be doing, trying to avoid that happening during his presidency. Personally, I still doubt it's going to be enough, but it definitely is not going to help the US or globally in the medium to long term, because as you said, you need to be running counter-cyclical policies, right? Theoretically speaking, you should be having surpluses during expansions so you can run deficits during recessions.
Right. Yeah. So this is pressing on the gas when we're already going 120 miles an hour. So it gets a little scary up at these speeds. Using the analogy of a vehicle, but anyway, Steve, it's great to always hear your thoughts, and I 100% agree with you. And I think it's in my opinion very dangerous time, and so you gotta from a currency trading standpoint, I think this is one of the things that makes trading the dollar at this stage in the game a little bit more difficult. But the euro looks like it's actually trying to roll over a little bit here, and I'm just going to obviously trade the charts because I can actually.
Absolutely, I agree with you 100%.
Yeah, it's almost at this point pointless trying to. I think there are there's a lot of crosswinds that are blowing at the moment. So price is going to be king, and I think being able to identify the key, technical levels in the markets and being able to cue off them are important. And that's why, hey, if I get another shot at shorting the euro dollar at 123, I'm going to do it. Right now, I'm kind of, sidelined at the moment. But those opportunities will present themselves, and maybe some cross rates have some good opportunities ahead of them, especially with some of these yen pairs. One thing, Steve, I'm going to turn over to you here in just 1 second. One thing that I made mention during the week ahead video, if you guys didn't see it, is this US dollar Japanese yen and how dangerously close we are to 108. This is obviously a very, very critical support for the dollar yen, and I was reading some bank analysis.
They saved it Friday with a false breakdown and brought it back.
Yeah, well, as the S&P hit the 200-day moving average, we rallied back too. But I'm going to tell you guys, if the dollar yen breaks 108, it's a game changer to me. If we get a foothold below 108 and especially below 107, 20 or whatever it is, that is a game changer for all the yen pairs. And you look at the euro yen, you look at the pound yen, Canadian yen, Aussie yen, they all look extremely vulnerable. So I think that's got to be on your radar right now.
What's $1 million question, Blake? Let's say, which in my opinion is going to create the most interesting environment to trade. Let's say that on Wednesday, because that's, in my opinion, at the current juncture that we are, you mentioned it at the beginning, the market is waiting. I mean, all sides of the market are waiting for the CPI print. So right. let's assume that we get a hot CPI on Wednesday. That will immediately, most likely, given what the trigger for the sell-off in the markets were, probably create another bout of risk-off and sell-off. But at the same time, obviously, it should reprice the expectations of the market about rate hikes this year, correct?
You could,
so, yeah. So the question is, what is the USD yen going to do then? I mean, if we have risk falling once again, but at the same time, USD rallying because of repricing the amount of rate hikes, we might start pricing more than 3 because now, after the risk sell-off.
Tough call because the yen should have been rallying with the bear market in bonds.
It is.
I mean, right? USD yen with yields going up normally when the correlation works, US dollar goes up.
The question is what is going to what is going to win in this competition of pulling it in 2 different directions? Is it going to be risk or is it going to be yields?
It's not so straightforward right now, but I think we'll have some clarity after Wednesday. I think Wednesday's the big day.
But I really think that until Wednesday, it's unlikely that we're going to see huge moves. I think everybody in the market will be waiting for that.
Yes, everybody I've talked to this morning, actually over the phone, has said the exact same thing. I'm waiting for Wednesday. So, all right, guys. Well, hey, I'm going to pass it back over to you, Steve.
Okay, Blake, have a nice day, mate.
You guys too. Happy Monday. Hope you guys all had a great weekend, and I will talk to you guys soon.
Okay, buddy.
Thanks.
See you later, mate. Bye-bye.
How are you, buddy?
I'm good, Dale. How have you been?
Good, bro.
How was the weekend? How's the weather?
Nice. Nice. You know, low 80s, high 70s.
Okay, nice.
Little rain today in Southern Cal, but we need it. We're in a drought again. So, yeah, I'm real interested in paying attention to what you have to say in here today, Steve.
Okay, I think we already have had a very interesting conversation having to do, you know, with the big picture with Blake. But yes, we do have charts to show because we do have interesting technical junctures. First of all, we already have a lot of questions, and you know, friends are sending things. I will show them. But let's begin by, you know, I want to begin this today with crude, because if you remember, what was the level I was targeting at crude, Dale?
58.80.
Yeah, and you know, the general vicinity of 58, we said, you know, worst case scenario, we can even go down to 55. So we tagged 58 on Friday. We seem to be reversing from there. To be honest, momentum seems quite strong, so it wouldn't surprise me if we got like another sell-off after this rebound. But I have to say that, you know, the easy move, I mean, the easy to prognose at least move for crude lower has happened.
Yeah.
Okay, we said that confirmation was at a break below 63. We got that, and as you see, technical levels are very important because the market, you know, fell like a rock after breaching that. So in essence, we dumped like more than $8 within a matter of a few days, as always, at a market that was stretched. One-sided positioning was one-sided, and since like a couple of weeks before we saw the actual high, we were getting the usual warning signals, all these reporter articles coming out, Bloomberg, etc., how bullish is oil and how bullish every indication about oil is, and how oil is not going to stop, and Goldman Sachs revising their targets to 80, and all the usual things you see just before you reach at least a short-term top, right? So if you remember, we were warning about that since we hit like 63. Obviously, you know, it's very hard to pinpoint the exact top of the market, but you know, we just went $3 more above there, and then we planned. So
yeah, we've been talking about that for a while, Steve, especially all last week once it got through that channel.
Yeah.
And even before it made the highs, we were constructive looking for 63. So, you know, our timing's been pretty good on the crude market for you know, major turns. Not perfect, but you know, my Pinkertism is don't expect perfection at the crap table.
Yeah, I like that.
Go to the crap table and, you know, try and pick a good entry and exit.
Okay, so bottom line, what's the 50 DMA can act as resistance here or a little bit higher, like 61, 62. Wouldn't surprise me if we saw one more low from here. But in general, you know, don't turn overly bearish, crude. Of course, this correction might last longer. I mean, you know, it can become a lot more complicated. It might be an ABC, and you know, we might have not even completed the A for now, so we might need like one more push lower, get an A, then get a rebound, then go lower probably towards 55, and then resume the upside, or it might be something shorter lived. So, you know, I was pretty sure that we're breaking lower. Now, having reached 58 so fast, so soon, although I would like 58 to be the low, the fact that we haven't corrected much in time makes me a little bit more skeptical that this was the low. Okay, having to do with price, it satisfies what I was expecting, but having to do with time, as I said, it seemed too fast. And you know, the market often needs also to correct somewhat in time and not only at matters of price, right? So we need a little bit more of this price action to evolve, so we can, so we can have a better opinion of what's going to happen from here. As you understand, that will obviously affect both the USD CAD and the USD NOK markets. We saw the spectacular and for many would have been unexpected rejection for the USD CAD, since we got like very bad very bad Canadian data, employment Canadian data last week on Friday. But a market does what a market wants to do, and technical levels do matter regardless of macro news. So as long as we hold that high, we might have a little bit more to the downside. I'm not assuming that the move higher is over, but we might need to see like, a few more days of a correction lower before actually pushing once again above the 126.60 level. USD NOK also had a huge, a huge in terms of speed correction after breaking briefly to new lows. I had already booked several days before that, anyhow, my short. So I have to tell you that I'm looking for a short opportunity once again. Friday's candle with a long upper wick after we met the 50 DMA definitely can act as as a first warning, but I want to see more to be short USD NOK once again. But I do want to be short USD NOK once again, even if you look at the long-term picture here. If we go on a weekly chart, okay, you can see that this is a market that can easily correct, quite lower from where it has. Of course, somebody can say that, this is a market that has chosen to correct in time, instead mostly on terms of price. But I'm really very, very unsure that that's all we are to see. I mean, that's like a tradable low there. Anyhow, being a believer in NOK strength and fundamentals of Norway, and in, believing that crude might have more upside, but not immediately, I am actively, and I will be actively looking for new opportunities to be short the USD NOK. Okay, it might not be today or tomorrow. I'm definitely going to be waiting for CPI data as well on Wednesday, as I said. But this is something that will remain in my radar, and I'm pretty sure I'm going to be involved with this market, rather soon once again. Now, having to do with the USD yen, we already said what had to be said about the CPI and its ability to cause at the same time both repricing in how many rate hikes we're going to get, but also cause the market to go in risk-off mode once again after perhaps stabilizing for a couple of days. I have to say though that USD yen for the time being is barely holding what seems to be like a bearish consolidation formation, likely a triangle or a pennant or whatever here. So on Friday we seem to be breaking below it. We actually managed to pare back the losses before the end of the day when we got that remarkable 900 handle rally on the Dow Jones and an equivalent rally in SPX, etc. But the USD yen obviously hasn't recovered that much, so it remains extremely heavy. This is something that's unavoidably noticeable. Also, the fact that the market seems to be attracted to the head and shoulders target, which is also, coincides with that low we had at 107.30, 30.18 to be exact. So, I remain of the opinion that at least one more push to the downside in the USD yen is a high probability scenario, right? Especially as long as we hold this 110.15 resistance area. I would definitely not be long the USD yen. So that's with this as well. Blake already mentioned, if you remember, I closed the rest of my position Friday being short the Aussie USD. Ideally, I would want to see a retest of the 0.79 area. If we get that, I'm going to start building once again a short Aussie USD position. I think that the preferred choice between the two of them, and saying between the two of them, I mean Aussie and Kiwi, for me remains the Aussie. Although Kiwi seems to be, acting much better to the downside today, but regardless, I'm still looking. I think technically speaking, the Aussie is much more clear than the Kiwi. So I would rather choose that to be short once again. And I'm probably going to be involved with that market, soon, unless we see something, that's going to change things remarkably. Blake already mentioned, and I'm going to show this. Listen, the DXY is obviously in the short term, I repeat, in bullish mode, right? We broke at a triple confluence of supports. We broke above this descending channel. If you see here, Thursday, Friday, Monday, obviously consolidation candles, right? Thursday it was a doji. Friday it was an inside spinning top after a doji. Today we started negative on the day, but for the time being we're seeing a hammer. So
yeah, just because it's slow grinding recovery doesn't mean it's not a recovery.
Yeah, and something, if we see at the same time on Wednesday, if we see something hot from the CPI, it's for sure that we're going to get a push higher in the DXY, and probably then we're going to see a break of 91. As we've warned long time ago, warned long time ago that this was, an ideal target to the downside. It worked, and I think there is a big chance that our second warning will work as well, meaning that if we manage to break above 91, we're going to see a big squeeze in the dollar shorts, because positioning is also still one-sided here. And if we break above 91, I think that position squaring and people running for the exits is going to create a snowball effect. So if CPI is hotter than expected on Wednesday, the dollar, instead of having a slow recovery, can really change form and start having like a brutal recovery, right? So I would be very, very careful being short the dollar. At least make sure, obviously the trend is your friend, and the trend in the dollar remains lower, there's no question about it. But in the context of where we found support and what kind of a reaction we have and what kind of a potential there is, in case we get that kind of a surprise, be very, very careful. If you are short the dollar, make sure that you don't stay short the dollar above 91, because I think that the chances that you're going to find yourself in loss, much faster than you would initially expect is quite high, right? So in essence, your position is in danger. A single print, which is Wednesday's print that the whole market is waiting, can completely reverse the outlook for the dollar in the short to medium term.
Steve, I'm wondering if we had the same or 61.8% of the magnitude of recovery that we had from the September low to the November high. Maybe that is, kind of an area we could look for. Maybe it's 92. That was what, about a 500, 400?
I think 92.60. If we break above 91, 92.60 is an area that inevitably is going to be tested. So
yeah,
I think
that's Grega's bull bear line, I think, around that level.
Yeah, so I think if we break above 91, the reaction that's going to create should at least be good enough to take us up to 92.60. 92.60 is an area of interest, because I'm zooming out here and you can see it has been an area that has acted as support resistance multiple times in the past. It's also the 61.8% fib from the high that we found in November, as you mentioned, to the low that we found a few days ago at the end of January.
And that would be the same magnitude of a bounce that we had from last fall.
Roughly, yeah. Roughly. It would roughly be the same, yeah. Yeah. Also, keep in mind, you see this descending trend line, that will also coincide with the 9260 in several days from now. You can see it here. Right? So it depends on how fast that happens. That can also end up being a triple confluence, right? So I think a break above 91 more or less guarantees, in my mind. Okay, I'm just transferring you what I see through, through my eyes. I mean, if I see a break of 91, I will really be actively expecting for 9260 to be tested, and then that's going to be the new major level for the trend. Because keep in mind, when you are in a very prolonged downtrend or in a very prolonged uptrend, doesn't really matter. When you're in a trend that is well established, anyhow, you don't get only one important level. You get one important level after the other. You break one, then you have another one. You break another one, you have another one. Because for you to get confirmation that a well-established trend is reversing, it's not a process of just breaking a single level, right? But there are levels that are quite important, and you know that when they break, they should create enough of a follow-through that will get you to the next level and then the next level. So, it's extremely important to have an idea of the technicals and, the areas of importance on a chart, because in essence, even if you cannot safely predict the reversal of a trend, you can at least rather safely predict, that another move in the counter trend direction is coming that will be roughly that big. So you can at least take advantage of these moves, even if they prove in retrospect to be just counter trend moves at the larger trend. Also, if you just want to align yourself with a bigger trend because you don't believe it's reversing, in this case, you have the levels in which it's a good idea to be looking for the trend to resume. So, you can take these levels and use them any way you see fit, but definitely they're helpful. Okay, let's go ahead and have a look at what our friends have been showing us. Euro double top, head and shoulders. Forex Gal was saying to Blake.
Steve, it looks like no guest.
Oh, okay. Really?
Yeah.
Okay, let's have a look at gold, by the way. Brett was talking about gold. He says 1,322. Let's have a look. I'm still short half a position in gold. Gold is reversing as well from the highs of the day today. I think that the important level, okay, we're not going to argue about that, plus or minus $1. For me, this area here of resistance is important as long as it remains intact in the short term. I think that another move to the downside to retest this zone, the 1300 area, is very, very, very likely, and that's why I'm holding my half position short in gold, because I'm expecting that 1300 has a high chance of being tested. Obviously, if we see a strong print in the CPI, we have a good chance of seeing that happen like instantly almost. Let's have a look at silver as well. More or less the same situation here. Silver, as for the past at least 1 year, usually underperforms gold. You can see that here as well. Don't forget though that there is a potential for a large inverted head and shoulders formation here for silver, but obviously for that to happen, we need to hold this area, let's say the 1560 area at the very least, and then head higher once again, and not take too much time to do that, because we also need some kind of a symmetry between the two shoulders. So ideally speaking, if silver wants to see this bull scenario manifesting, it should roughly soon head to the upside and break above this neckline. So this is just a potential scenario, because we still have no real evidence that that's going to happen, but it's a scenario monitoring. In the short term, obviously silver remains under pressure. The next area of support is at $16. That's the situation. And it's one more chart I want to show about the metals. I was short last week, and I took profits and I'm looking to be short once again. Might not get the ability. I was hoping earlier today we were about to test 1,000 again. I had an order to go short at 999 to be exact, which didn't get triggered. I was hoping for this kind of a rebound and another move lower towards 900 for palladium. I'm not sure if I'm willing to chase after it because I still like it to the downside. I might like put on at market 1/3 of a position short. I'm going to consider it. I'm going to see what I'm going to do later today, and then add more if we rebound, or add more if we actually break below the lows. But I do believe that palladium might have more to the downside. I don't see any real support until 900. It is the 200 daily moving average at 944. But to be honest, it hasn't acted as support for a long time. I mean, we've been above it, like for a big period of time. So I'm more inclined to believe that, if we resume here to the downside, we're going to get back to 900. So that's it with metals. Let's see what else we have. Trump is coming out today with his 1.5 trillion infrastructure plan. Yeah, Brett, we already commented on that. I think it's a very, very wrong decision that is absolutely 100% biased. And unfortunately, it's not only Trump that's been doing that. It's politicians all over the world. Just on, probably just wanting to prolong this business cycle a little bit more so the next recession doesn't coincide with his presidency. Personally, I believe that the chances of that not happening are very low regardless. Forex Gal says debt to balloon. Yep, those are comments on the conversation we had before. Blake, what do you think about the USD yen? Okay, he already answered that. Nick says, hey Steve, what do you make of this? Let me see. And obviously he's posting a chart here. Yeah.
There's your car.
Yeah, running hot. America's extraordinary economic gamble. I agree, actually.
Yeah.
I agree.
What they used to call those, funny cars? With the, big wheels in the back.
Dragster cars, I think, yeah.
Yeah, drag racers.
Yeah. Hi, Dale and Silianos. Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi. Yeah, sure. Let's have a look at them all.
By the way, Steve, how's Greece doing in the Winter Olympics? That's Olympic.
We don't have winter sports in Greece, as you understand.
It was rhetorical.
Yeah. Actually, something? I doubt we've ever got any medals in Winter Olympics. I have no idea. I seriously doubt it because we have so good weather that, we don't actually have winter sports.
Yeah, and always too busy building horses. Trojan. Yeah, I know. Okay, Euro Aussie. Euro Aussie is in some kind of a correction, can be a flag. Okay, something like this. Yeah, Greg said it gave up nothing during the market correction on Tuesday. That's why he still likes it. Yeah.
You know something, from the structure I still see, I remain bullish as long as we are above 155. Let's call it 155.70, Abdul. Okay. Let's see at Euro Kiwi. Euro Kiwi is very, very choppy. There's no question about it. I mean, it has been extremely choppy. It gave us an inverted head and shoulders formation. It broke to the upside with some momentum, and that was it. It was a single day of upside momentum. And since then, we've just been in a very, very choppy range. This can be a triangle or whatever. Big picture. As long as we remain above this ascending channels support, it doesn't make sense turning bearish. But on the other hand, the upside momentum is really, really lacking at the moment. So I wouldn't be doing anything with it. I would just be, staying in the outside, monitoring, and wait for the market to, give me better indications of what's about to do. So, a slight bullish bias, but a very slight one. Pound Aussie. Pound Aussie, the problem with Pound Aussie is that, if it breaks below here, that it's testing at the moment, it's in danger of, triggering a double top formation, and that should bring us at least back to the 173.65 area. Okay, so far so good. When we were there, we had drawn this, that we can pull back, come down to this area, retest it, and then move to new highs. That's exactly what we did, but instead of moving to new highs, we retested the previous highs, and then we got rejected. So, long-term picture, we remain above this triangle, which can be interpreted also as a long-term bottoming pattern, but on the other hand, also lacking upside momentum, right? So honestly, I'm just monitoring all these pairs. Same here, pound Kiwi broke above this long-term likely bottoming formation, but upside is lacking. So
Steve,
this is.
How about? I'm sorry. Go ahead.
Absolutely, no problem. Ask away, Dale.
The Aussie Kiwi, I know a lot of people have been following it. It's coming off some pretty important support. I know you're trading the Aussie. I'm wondering what your views are on that cross.
These are my views on this cross. I drew them a few days ago.
Oh,
1082 to 1085, this zone was very important.
Okay.
We broke below it.
And we're testing it again. Yeah.
There is a good chance that upon a retest, we're about to retest it, we might get rejected this time. So a zone that acted several times as support might start acting as a resistance from this point on.
Okay,
right?
If we close above that, would you view it as a false breakdown, and then maybe there's a case for long?
Yeah.
Okay.
But still,
like
my main interpretation.
Yeah. Trap between 61.8 and breakdown.
Yeah, but still, my main interpretation, would remain one of a choppy market. I mean, if we falsely break below it, I would still tend to believe that it was a false break, but still, I have no indication to view it as a choppy market. The reason I'm a little bit skeptical is because this is not beautiful, but regardless, it is a head and shoulders formation, right?
Yeah, we kind of had that in Euro a few months back, and if it takes too much time to get going to the downside,
I agree with you.
It makes me a little skeptical of the.
I agree with you. That's why it's important to see, because this is also a retest of a potential head and shoulders formation. That's why I'm really interested to see if we're going to get an immediate reaction from here. If we do, then I'm going to be very bearish the Aussie Kiwi, which adds to my scenario that my preferred short is the Aussie, right? Now, if we break again above here, but we don't create the momentum that you see sometimes when you get a false break and then you break again above, and suddenly you see that false break got people trapped in the wrong direction, and then you see a brutal move to the other direction. So if we break above here and we start doing things like that once again, I'm gonna be okay, just leave this market do whatever the hell it wants. You know what the situation is gonna be? You remember how many times in the recent past, it's a lot, you've asked me about Euro Pound.
Yeah, it's a non-trade to you.
Yeah, and how many times did I tell you?
It's you've been right. It's still stuck in the range.
Nothing to see here, right? And
I'm the only one.
Really, there's really nothing to see here. Nothing. I mean, is it going to move at some point? Absolutely. But should they be, on the jitters every time we see 2-3 days of strength or weakness? Should they be oh, okay, now this is the opportunity. Now it's going to really move.
Yeah, it's going to do it this time. Yeah.
No, I have no reason to do that, right? It's already, let me see. We entered this slightly descending channel.
8 months.
September. Right? And we're currently in the middle of February, and we're still discussing about the same range. I mean, who cares? Let it do whatever it wants to do.
It's groundhog. It's a groundhog.
Yeah, exactly. Once it finally clears this range, you know, we can be interested once again. And you know something, the longer term view about the euro pound, a likely long term view remains this. So ideally speaking, I would want to see it end up breaking to the downside for one more push lower at least.
Okay.
Ideally speaking, but honestly, I'm not going to be trying to, you know, force the market to do something it's obviously not willing to do so.
How about copper? Someone's asking about copper, and maybe we could wrap it.
Absolutely. Copper remains in, oh, sorry, this is the weekly chart. Okay, weekly, regardless, weekly can give you a good idea. Seeing that since the very, very beginning of 2016, we've been in an uptrend, and this is something that you need to respect, okay? Because it's a very long time. It's already like 13 plus months that we've been in an uptrend. So, you know, that means that you should be careful trying to be short copper, and I'm not talking about short-term trades, obviously, because short-term trades shouldn't care about, you know, what the longer-term view is. But I have to tell you something. We had a brutal leg higher here. I mean, copper was literally going up every single day.
With the blow off in S&Ps, right?
2, 4, 6, 8, 10, 12, 14, 16 days. In 16 days, copper was, copper was slightly lower, only 1. And now we're seeing a move lower, right? But its characteristics, although somebody can say, oh, we had like a very strong down day here and one there, but the characteristics still don't tell me that this is an impulsive move lower. So I have to tell you that as long as we remain above here, this horizontal support resistance area, the 200 DMA is also here now. I mean, it has reached this zone as well. I think that, you know, you should respect the potential for more upside. Okay. On the other hand, if you're really looking to be short copper, I don't think you should be doing it here. You should be doing it on a retest of this zone, right?
Yeah.
But if we break above this zone once again, I think that the uptrend is resuming. So, you know, nothing really has changed in the medium to long-term outlook about copper. I mean, we don't have a strong indication to say, okay, copper has found a high. We will need a lot more evidence to say that. Until then, we need to respect the potential for more upside. Okay.
Thank you, buddy.
Okay, my pleasure. So I'll see you all in the chat room, or else, you know, everybody else. Okay, tomorrow, our usual time.
All righty. Okay, Eagles, that's a wrap. See everyone tomorrow for Turnaround Tuesday. I have a lady coming in tomorrow, female trader, trade out loud, so she's not shy. Looking forward to that interview. Thank you, everyone. You're very welcome, Nick, Elena, Kareem, Abdul. Good hunting. See you in the chat room. If you're not a subscriber yet, I'll see you in the chat room after you join. So, plenty of action. If you like what Steve and Blake have to say, you're going to get more of it in the private chat. So, everyone have a great day. Looking forward to Turnaround Tuesday. And remember, don't just count your pips, count your blessings. See everyone tomorrow. Enjoy your day.